Hello dear viewers, welcome once again to my new lecture. Today my lecture topic is cost. Cost is very important for the businesses because as the rational producers, businesses always try to maximize their profit, and one of the easiest way to maximize the profit is to minimize the cost. So businesses have to understand different types of cost. So what is cost? Cost is simply the expenses while producing goods and services. Okay, some cost do not depend on the production level, and some cost depends on the production level. For example, when there is no production at all, there are some cost. Business has to bear some cost. These are called the fixed cost. And some cost business, when the business does not produce anything at all, then there is no cost. These costs are called variable cost. So in this lecture, I'm going to explain different types of cost depending on the production, and I'll show you how to calculate profit of a business and show different shapes of the cost curve. So right now, let me start the detail of today's lecture. All right, so cost. What is cost? Cost in general is the monetary value of goods and services that producers and consumers purchase. That means when consumers are purchasing some goods and services, they will have to pay. This payment is cost for the consumers. And when the businesses produce goods and services, they have to pay for the raw material, they have to pay for the workers as salary, they have to pay to the bankers or the lenders as the interest payment, and they have to pay rent for their capital hiring. So these are costs for the businesses. All right. That means in production, a cost is the value of money that has been made up to produce something or deliver a service, and hence is not available for use anymore. Therefore, in business, cost are the expenses that must be met when setting up a business or running a business, which is also known as production cost. So business cost is simply the production cost itself. So here there are some examples of cost, so manufacturing cost, non-manufacturing cost. Manufacturing cost are direct materials, then direct labor, then factory overheads, and non-manufacturing cost are selling expenses and other administrative expenses. So these all together called cost of the business or production cost. That means production cost can include a variety of expenses such as labor, raw materials, consumable manufacturing supplies, and general overhead. Product cost may also include those incurred as part of the delivery of a service to a customer. So these all together is called cost of the business. Now let me show you different types of cost or production cost. Cost can be classified according to how they behave when output changes. Some cost remains same whatever the level of output, but some cost change as output changes. Therefore, cost can be classified into the following types. First, fixed cost, which do not change with the level of output. Then comes variable cost. This type of cost change with the level of output. Then we can calculate total cost using by adding up this fixed cost and variable cost, and next we can calculate average cost. Average cost means the per unit production cost. All right. Now let me discuss at first fixed cost. A fixed cost is a cost that does not change with an increase or decrease in the amount of goods and services supplied or produced by the businesses. Fixed costs are expenses that have to be paid by a company independent of any specific business activities. That means this type of costs do not depend on the production. Whatever the production level is, the business must meet these expenses or this cost. For example, say when there is no production, the business has to pay the rent for the premises, the business has to pay the interest payment, the business has to pay the insurance premiums and the salaries of the permanent staff. So these are called the fixed costs. This type of cost do not depends on the production. Whether the production level is, if it is more, if it is less, even zero, these are the fixed costs. The business has to pay this. Okay, example of fixed costs, some examples again mentioned here. So rent, business rates, advertising, insurance premiums, interest payments, staff salary, research and development, etc. So these are the fixed costs. Whatever the output level is, if there is no production at all, the business have to meet this cost. Okay, those costs will not increase even if a farm produces more output. Okay, that means if farms increase the output level, this cost will not increase. However, this cost will still have to be met if the farm produces nothing. Fixed cost or total fixed cost are also known as overheads. All right, since a change in the level of output does not affect the fixed cost curve is parallel to the horizontal axis. This is also very important to understand why the shape of the fixed cost curve is parallel to the horizontal axis. The reason is it does not depend on the level of output. Okay, it is independent. All right. Now, for example, total fixed cost of a farm is 40,000 US dollar per annum. And when the output level is 100, fixed cost is 40,000. When output increases to 150, 200, 250 or 300, still fixed cost is 40,000. That means whatever the output level is, even if output level is 0, then also fixed cost is 40,000. Right? Now look at this diagram here. Say here, so when the output level is 0, fixed cost is 40,000 US dollar. If when output increases from 0 to 50, output is still average fixed cost is still 40,000. If output increases from 50 to 100, 100 to 150, 200 to 150, like that, still the fixed cost is same. It is still 40,000 US dollar. That is why the shape of this fixed cost curve is horizontal, parallel to the horizontal axis. All right. Now come to variable cost. Variable costs are just opposite of fixed costs, but it means variable costs are expenses that vary in production to the volume of goods and services that a business produces. In other words, they are costs that vary depending on the volume of activity. As activity or volume of output increases, this type of cost will also increase, and vice versa. So production costs that change when the level of output changes are called variable cost. If a firm produces more output, business variable cost will increase. Similarly, if output levels are cut, variable cost will fall. That means variable costs are directly related with production level. If there is no production, variable cost will be 0. All right. Examples of variable cost include raw materials, packaging, fuel, and labor. That means when you increase production, you have to buy raw materials, you have to spend money for packaging, you have to purchase, you have to pay for fuel, and you have to pay for the temporary workers. So these are the variable costs. This cost depend on the production. If production is more, then you will have to pay more. If production is less, business will have to pay less. Total variable cost is variable cost per unit multiplied by the number of units output. So this is also very important. Total variable cost. Variable cost and total variable cost are the same. Variable cost, those cost will change. So total variable cost is a variable cost times quantity produced. For example, per unit variable cost of a business is 500 US dollar. To produce one single unit, the business average cost, variable cost is 500 US dollar. If the business produces 100 units of output, the total variable cost will be 500 times 100 equals to 50,000. And if output increases to 150, then total variable cost will also increase. It will be 500 times 150 equals to 75,000. That means total variable cost increases as output increases. Now look at this variable cost curve. See, variable cost curve starts from the origin and it is proportionately related with the production. Say when output level is 0, look at here at the origin, when output level is 0, variable cost is 0. If output increases to 50, then variable cost will also increase. Say it will increase maybe say 25. Then if output is 100, variable cost is say 50. Then if output is 150 and variable cost say it is 75. Okay. So this is how, as output increases, variable cost also increases. That is why variable cost curve is positively sloped, and it starts from the origin. It means zero production, zero variable cost. So the more production, the more variable cost. That is why the shape of the variable cost curve is upward sloping. Now come to the total cost. The cost to a farm of producing all output over a period of time is called the total cost. That means total cost is the sum of variable cost and the fixed cost. So here we use the term total fixed cost and total variable cost to get total cost. That means the formula of total cost is TFC plus TVC, which means that total cost equals to total fixed cost plus total variable cost. To make it easy, let's look at this example. If total fixed cost of a farm is 40,000 US dollar and variable cost per unit of output is $500 to produce 100 units, then total cost will be 40,000 plus 100 times 500 equals to 40,000 plus 50,000. Finally, it is 90,000. That means total cost of producing 100 units of the farm is 90,000 US dollar. Now look at this total cost curve. Look here, see, total cost curve starts always from the vertical axis. Why? Because whatever the output level is, see here, output level is 0. There is no output at all, but average there is fixed cost. Okay, fixed cost is 40,000. Okay, so it will start. Total cost curve will start from the vertical axis because there is always a fixed cost. So here in this example, when output level is 0, that means business is not producing anything at all. Still they have the fixed cost 40,000 US dollar. So from here total cost curve starts. Then afterwards, as output increases, then cost also increases. That is variable cost. Okay. See here, if output is 100, then what is the total cost? Total cost is, say here, 90. Okay. If output is 100, total cost is 90 here. See, that means to produce these 100 units, business total fixed cost is 40,000 US dollar, and this difference 40,000 to 90,000, that means this 50,000 is the variable cost. Okay, so this is fixed cost and this is the variable cost. Okay, that is why the total cost curve starts from the vertical axis, and it is also upward sloping because as output increases, variable cost also increases. Now come to the average cost. The average cost of production is the cost of producing a single unit of output. Okay, the formula of calculating average cost is average cost equals to total cost divided by total quantity produced. That means S equals TC divided by TP. For example, if the total cost of a farm is 90,000 US dollar producing 100 units of output, then the average cost will be 90,000 divided by 100 equals to 900. That means to produce a single unit of output, business has to spend 900 US dollar. So this is the average cost of the business of producing a single unit. Now come to the average cost curve. The average cost for a business can be shown graphically. The average cost curve is U-shaped. This is very important. Why the average cost curve is U-shaped? This is because as output increases, average cost falls at first initially. Then after a certain limit, then it starts to increase. That is why the average cost curve is U-shaped. Now let me show you the U-shaped average cost curve. So look at this cost curve. This is U-shaped. All right. See here. When, for example, output level is 100, okay? When output is 100, the average cost is 25, okay? So that means to produce 100 units, the business has to spend 25, here we use the unit pound, okay? So to produce 100 units, the business has to spend 25 pounds for each unit. The average cost is 25. Now, as output increases from 100 to 300, so average cost is here 7.5. Okay, so when output increased 100 to 300, average cost per unit fell down from 25 to 7.5. All right, but if output is further increases from 300 to 400, then our average cost will again increase. So here, for producing output 400, average cost is here 10. If the business again increase output to 500, then average cost will be 25 again, which means that this is the maximum output level where average cost is lowest. If the business produces more, then average cost will increase. Why? Because the business, so with this existing capacity, maximum the business can produce 300 units. All right. So if the business produces 300 units with the max available capacity, then average cost will be minimized, lowest. But if the business wants to produce more than their maximum capacity, then they will have to increase their production capacity. They will have to recruit more workers, they have to buy more raw materials, more capital. So in that case, their cost will increase. So average cost will also increase. Well, that means till here, to produce till 300 units, average cost per unit is 7.5. But if the business wants to produce 100 units extra, that means this 300 to 400, for this 100 extra units, the average cost increases from 7.5 to 10. That means here average cost for each unit is 10. All right. So this is for this reason the average cost curve is U-shaped. That means at first average cost falls as output increases, but after a certain limit, then output also, as output increases, average cost also increases. That is why the average cost curve is U-shaped. Now come to the total revenue. Total revenue is the money the firm receives from selling its output. Right? Total revenue can be calculated by multiplying the price of each unit by the number of units sold. So the formula of total revenue is very simple. Total revenue equals to price times quantity sold, or TR equals to P times QS. For example, if a firm charges $1,500 for each unit, all right, and sells 100 units of output, then total revenue is $1,500 times 100 equals to $150,000. So this is the total revenue of the firm. Now come to the profit. One of the main reasons why firms calculate their cost and revenues is to work out profit or loss. Profit or loss is the difference between total revenue and total cost. Therefore, profit equals to total revenue minus total cost, or profit equals to TR minus TC. This is very important. See here, if TR, that means total revenue, is greater than total cost, then it is profit. And if TC, or total cost, is greater than total revenue, then it is loss. All right. For example, if total revenue of a business is $150,000 by selling 100 units, and total cost are $90,000 to produce these 100 units output, then the profit of the business is 150,000 minus 90,000 equals to 60,000. That means here the business is making profit as revenue is greater than the cost. All right. So this is all about the cost, revenues, and profit of the business. So business has to be very, very careful about their calculation of the profit, because if they make any mistake in calculating their cost and revenue, then they will incur loss. So to avoid this loss, business has to carefully calculate their cost, different types of cost, and has to keep the cost as low as possible. All right. So this is all about today's lecture. Thank you very much for joining me, and I hope this lecture will help you a lot.